Welcome to episode 402 of the Be Smart podcast. Joining us today is Josh Jalinski, founder and CEO of Jalinski Advisory Group and Wealth Quarterback LLC. Josh is a prominent financial advisor recognized by Forbes as one of America's top financial security professionals for 3 consecutive years. As the host of the Financial Quarterback radio show, Josh offers live financial guidance tackling real-time listener questions with his signature blend of expertise and insight. He also leads the Financial Quarterback podcast, where he explores modern financial strategies from retirement planning to cutting-edge economic trends. His book, Retirement Reality Check, challenges outdated financial wisdom, offering innovative ways to protect and grow wealth. With that, Josh, thank you for joining us here today.
Thanks for having me. Been a fan of Jared's for years. So
yeah, I used to go on your radio show this is 7 years ago, 8 years ago. I used to come on.
Yeah. When you started the Daily Dirt Nap. And I don't know if you remember, there was a book that you came out with. What was it Street Freak? Your first book? Was that your first?
Yep.
And I still remember my father read it. And we were giving it away to all these. He's like, "You're going to give all these old people a heart attack."
Yeah. I'm going to jump right in here. Now's like a super interesting time to be talking to a financial advisor, a real live financial advisor. So my mom has a financial advisor. I don't directly manage her investments because we would fight all the time. Like we would literally just fight like cats and dogs. So she's like, I'm getting a financial advisor. So she's with a firm, which I will not name. And if you've been reading my stuff, you know that I've been talking about this.
Yeah, I've seen this on your Twitter account, your X account.
Yeah. So I've been talking about this divergence between the U.S. and the rest of the world, and how U.S. stocks are getting more and more overvalued and the rest of the world is getting more and more undervalued. And there's been a lot of articles. Wall Street Journal had one talking about how people have like this 70-20-10 allocation. They have 70% stocks, 20% bonds, and 10% international. And they're like, why do I have this international? Like I lose money all the time. Like, why do I have this international piece? And obviously it's there for diversification. And, diversification means you have something in your portfolio that you hate, right? Like otherwise you're not diversified. Anyway, I got a call from my mom last week. She said, my financial advisor is telling me to get out of international stocks. Right. So I wanted to get your take on that. After 15 years of underperformance, now is the time to get out of international stocks, right?
Yeah, I mean, it seems like a bad timing. So I would do the reverse of what he's saying. Although I want to commend you. I have many clients whose kids are in the industry and the kids are problems. So I want to commend you first. If you have family members, do exactly what Jared's doing. If your mother, it is better to have a relationship with your mother or father untainted from greed or fear or economic cycles. So that way Christmas is Christmas, Hanukkah's Hanukkah, Thanksgiving's Thanksgiving. You don't hear too many people do what you did, but I think that's a lot of speaks to your maturity and wisdom. I mean, I remember my mother would give me a hard time about certain things, and I love my mother dearly. She passed. And, I think of like the last 10 years of my life with my mother, and she would give me a hard time about things that I wish I had that time back.
Yep.
And we weren't fighting about, she worked for me her last 10 years of life. And I wish I just pampered my mom for the last 10 years and she didn't work for me, because it does change the nature of the relationship a little bit when your mother's going to you for advice. Totally. So that's wisdom. Number 2, a lot of people right now are falling into the same trap of January 2020, January 2022. Was it 22?
Yep.
December 21. Where they are throwing out wisdom. And I love talking to you because you're one of the few people that gets it that I read on the importance of bonds, diversification. I think you have I don't know what it's called, but it's something I want to, it's not the all weather portfolio, but
The
you have
awesome
something.
portfolio.
Yeah. I always thought that was wise. People don't get that when you're building a portfolio for a retired person or someone near retirement, 5 to 10 years, the standard rules of thumb of being all FANG stocks, put all your money in the S&P 500, that is not a wise way to construct a portfolio for a pre-retiree or retiree. So I'm glad that you bring that up on a regular basis to your people with kind of wit and kind of simple. But why is it so hard though? Like people just don't get like proper diversification, proper asset allocation. I guess it's the old fear and greed cycle.
Yeah, just greed takes over. And in my job as a newsletter writer, I get emails from hundreds of people telling me stories about their parents, about, yeah, it seems to be pretty common among FAs that they have an 80-year-old client that's in 70% stocks, you know. And it's a fight to get them to 50% when they really should be in 20%, or 30%. It's, like you said, January 22, January of 2020, other points in history, like, greed takes over. And, my mom's financial advisor, I think his heart is in the right place. He wants her to make more money. And I have these conversations with him. I'm like, dude, she is 79, right? The goal isn't to make more money. The goal is to not lose it. Like that's the goal, right? When you're 79 years old, right? So, I have probably 300 to 500 FAs that subscribe to my newsletter, and I've met a ton of them in person. They're all great, and they tend to agree with me on this kind of stuff. But the amount of risk appetite out there, like in this bull market, is just off the charts. Totally
It's
off
insane.
the charts. Yeah.
I came into the business probably when you did, but I remember the old rule of 100. So if you had it's not scientific in any way, but if you had a 79-year-old client, you deduct 100, they should have 21% in equities and 79% in bonds and fixed income. It has its problems, but that used to be the rule of thumb when I came into the industry. Now it's like 70, 80% equities,
Yeah.
is a fight. I think if anybody's retiring, they should have no more than 60% in equities as a general rule of thumb. But it is hard when I think financial advisors want to justify themselves and justify the fee. So like they're getting hit from children of clients, and the children are saying, "Oh, you can put everything in Vanguard, S&P 500, and make 20%. Why do you need to pay an advisor a fee?" Well, you need to pay an advisor a fee if that's you, because most people do not have the mental bandwidth. They don't have the psychological bandwidth for this. They don't want to be worried. I mean, I had a dear client in today. She goes, "Josh, she followed stocks her whole life. She's like, I don't want to worry about this anymore. I'm 80." So too many of people who subscribe to financial newsletters are trying to beat the index. And a good financial advisor is never going to beat the index. They're going to keep you from vomiting out your portfolio the next, 2022 crash we have, the next 2020 crash we have, because those are the saddest people, the people who sell in the middle of a crash. That's what we're trying to avoid generally as financial advisors.
It's behavioral coaching. You know what I mean? It's behavioral coaching is what I would call it. That's the value proposition, because when it's one person with their Vanguard account staring at their computer in the middle of the night, it's March of 2020, it's the pandemic, the market is down 35%. They had $1 million portfolio. It's now worth $650,000. It's the middle of the night and they can't take it anymore, and they hit the sell button because they don't have somebody they trust to talk to them on the phone and say, look, like it's actually going to be okay. We've been through this a bunch of times before. This is not new. Like, just, hang on. In fact, this is actually a good time to add, like that's what a good financial advisor should do.
Exactly. I remember, I kind of keep it as a badge of honor We only had one or two people sell during that COVID 2020 low, and I was proud of that. But that one or two that sold in the middle of the crash hurt. I mean, I remember telling them, "Hey, you don't want to do this," and then they're screaming, "Oh, this time's different," even though whatever, um, and it seems so trite, but even Vanguard had a research report they did called Vanguard Advisor Alpha.
Oh,
And
yeah.
they said
I know about this. I know all about this. Yeah.
Yeah, that's a huge report. Everybody should Google it. Vanguard Advisor Alpha. They say a financial advisor utilizing just their index funds generated an extra 300 basis points of excess return over the indexes than the typical person doing it themselves, which is hard. But it's like I hired a personal trainer this year for the first time. I know that I'm supposed to eat right and exercise, but and I know what to do. I spent a number of years in the gym, but hiring a personal trainer, even though I know what to do, it helped me greatly. So I think the same's true for a financial advisor often. Of course, it's what I do for a living, but
You seem like a pretty young guy. When did you start your firm? How long you been doing it? Just give us a little bit of your bio.
Sure. I started out of seminary. I was recruited by a Wall Street hunter who would go to seminaries, Wall Street headhunter. And that was about 2004, and kind of came of age. I'd worked for a bank in their investment division in college for a little bit. So I was always intrigued by the stock market, always had newspapers where I'd look at my first stock. I remember was Santander Bank back when it was called Sovereign Bank. And my father worked for Sovereign Bank, and he gave me, I think, one share of bank stock. And I would look every day at the newspaper. And I've always had a kind of an interest in stocks. And then was recruited at a seminary by a guy who's now a missionary, but he's a Wall Street headhunter. And he went to seminaries because he thought, hey, you care about people. And that was kind of in the wake of the Arthur Andersen kind of Enron thing. So they were trying some new techniques of where they would recruit. And then started my firm in about 2005, 2006. And I had worked for a large firm, and I went to the guy in the corner office and I said, oh, what should I do? And he said, leave, go independent right away before they get the golden handcuffs on you. And that was one of the best decisions I ever did, just going independent early. So before it was a thing to be an RIA and to be an independent advisor, because when we were, I don't know, might be similar age, the big name people, my mother, remember, would be like, why aren't you with Merrill Lynch or Morgan Stanley or, some big name firm? That was still a thing up until about 2008, I think. So I went independent early, and it proved to be a good decision, although early it might have been rough to kind of hang my own shingle out.
So I'm enjoying being a fly on the wall here, just hearing you two smart dudes talk it out. But I want to jump in here, Josh, and ask you a little bit about your radio show and podcast, The Financial Quarterback. I take it you're a football guy. And if so, we got to set the stage here. I got to know which teams you root for. This is very important.
I like the Detroit Lions. Now, why do I like the Detroit Lions? I'm not a bandwagon jumper. I've liked them ever since Barry Sanders. I just like the way he played. He didn't do any of the funky dances. He was humble. The best running back I've ever seen. I wasn't, around to see Jim Brown, but saw Walter Payton a little bit. Thought Barry Sanders was better than Walter Payton. But the Detroit Lions, why did I like the Detroit Lions? Every week, my father would bring out the newspaper. It was the old Asbury Park Press from Asbury Park, New Jersey. And I don't know if when you were a kid, they had these. They had like the matchups of the week, and we would circle who we would think would win. Now, this was before, points and all the gambling websites, but we would even do the spread and the points and who would win, and we'd see who would win, and we would keep track of who predicted the best, who had the best record of prediction. And I had a better record of predicting games than my father. even as like a 7-year-old. But I always liked the Detroit Lions because I liked the lion on their helmet. That's why I liked them. So I'm finally getting some benefit, although now they're too injured. So I'm a long-suffering Lions fan.
As most Lions fans are.
So I've liked them
tough
since
game with the
80s.
Bills yesterday.
Yeah, I don't actually, after seeing that, I don't think they're going to win the Super Bowl this year. I think they're too injured.
Yeah.
I think they'll get to the NFC Championship or something and lose. Maybe they'll get to the Super Bowl, but I just don't think they have what it takes to beat the Bills. The Bills they had a great game plan. People gave them a hard time over that. Going for it, the onside kick, 12 minutes into the fourth quarter, you know what I'm talking about?
Oh, yeah, saw that.
Very questionable decision there.
I don't think it was, though, because they were not able to stop them. So
Yeah,
I think
true.
they were trying to kill.
Hole.
They just couldn't stop their offense. So I think the Bills look really good.
Really
so
good.
did the Eagles, and so did the Chiefs. I don't know. I think the NFL's a little rigged. That the Chiefs seem to always come out victorious.
If you're the financial quarterback, I'm like the financial right guard because I just keep getting fatter and fatter. So
you need a good right guard, though. You need a good offensive line, to block the sacks.
Obviously, I don't work on the advisory side of things. I was a trader for Lehman for 7 years. I was on the floor of the P-Coast before that. I've been doing the newsletter now this is my 17th year of doing the newsletter. Been doing it for a long time.
Were you always with Malden Economics?
No. So I started with them in 2014. So it's been 10 years. I'm actually not with Malden at the moment. I basically spun off and started Jared Dillian Money. But that relationship started in 2014, and I wrote The 10th Man for like 9.5 years, almost 10 years. And that's what you used to read. So
yeah,
that's
the best.
The free letter is called the Jared Dillian Letter at Jared Dillian Money. So
fantastic. Always like your work.
Thanks.
You guys want to talk a little Bitcoin here?
Oh, what the hell? Why not?
Yeah. So Bitcoin rises to record after longest weekly winning run since 2021. It's pulled back a little. It was at about 107 earlier. It's about 105.7 now. Bitcoin sitting basically at the all-time highs. I'll start with you, Josh. What hesitations, if any, would you have investing in it on the highs?
I mean, it tends to just be a bad asset class to invest when everybody else wants to be in it. Bitcoin seems to be a good thing to buy when everybody hates it, like the crypto winter after the FTX meltdown. Although Bitcoin maximalists who I hang out with a lot would say it's going to get to 13 million and all that. So there's never a bad time to buy. I think with Bitcoin, it's something you want to have maybe a 1 or 2% exposure to, but I'm not, I'm not crazy into it.
So it doesn't play like a major role in like modern portfolios in your view?
I think in the last 13, 14 years, if you had a 1 or 2% exposure to Bitcoin, it would have been a great hedge. I don't know if it will going forward, but that's the thesis. So to have 1 or 2% now might not be a bad thing. But I don't really like other cryptocurrencies. I tend to like Bitcoin only. Just because to me, it's like the Amazon of online retail. It's the Amazon of cryptocurrencies. It's either the whole project's going to do well or not. Although it would be funny to kind of be contrarian and say now that everybody thinks Donald Trump's going to be the Bitcoin president and have a Bitcoin strategic reserve, what if they pivot?
Could you guys break that down for me? Like, what's the use of having a Bitcoin reserve? I don't entirely understand it.
I don't understand it either. I don't know why you would want to do that. But if they do that, Bitcoin's definitely going to go a lot higher for sure. Did you know that MicroStrategy now owns 1.7% of all Bitcoin?
Yeah, it's going to be in the NASDAQ 100 too, I saw.
Yeah, I don't like the MicroStrategy story in Bitcoin. To me, it undermines the whole Bitcoin thesis. The whole idea of Bitcoin was that you were supposed to have decentralized money, and now you have these central players kind of manipulating, or they could manipulate supply. That kind of worries me. But
here's another interesting statistic. So all the Bitcoin ETFs collectively now have a larger position than the original Satoshi wallet.
yeah, I mean, that's another thing. Like, do we really want BlackRock controlling the world's Bitcoin supply? I don't know. I just think it's funny that I love Bitcoin. I'm a believer in it. It's strange how this kind of non-mainstream countercultural asset is now doing so well because
it's been
mainstream financial people, presidents are now saying, hey, we want a Bitcoin strategic reserve. I do think we're going to have one because Senator Loomis has been for this for years. People laughed at her. Now it looks like it's going to become a thing. It's like going to be like a gold reserve. Does it make sense? I don't know. But
Josh, you don't have to answer this, but I'm just curious. Do any of your clients have any of the Bitcoin ETFs in their portfolio?
Yes, because of SEC and compliance, we don't. This was the other thing. People talked about the ETFs being gateways for guys like me and RIAs to add a 1 or 2% exposure, like across the board. But our compliance council has always said, don't do that. Like everybody has to sign their own risk profile, their own risk disclosure. Although, did you ever have that guy, Richard Smith? You know what I'm talking about? He's like some quant guy. He has this theory that if you had a 1 or 2%, he's not a Bitcoin maxi, but that Bitcoin would have helped an overall diversified portfolio. I mean, obviously, because it's done well, but just a 1 to 2% exposure would have hedged portfolios better. But I haven't seen the numbers on that lately, but he was a big advocate of that. I mean, I think theoretically, right? If you want to have a certain exposure to gold, you want to have a certain exposure to Bitcoin because it's the digital gold of today. I mean, it's definitely an innovation in money, what's going on.
Let's talk about the dollar a little bit here. So Wall Street's starting to sour on the dollar as Trump's policies and the Fed's interest rate cuts will likely put pressure on the greenback in the latter portion of 2025. Roughly a half dozen sell-side strategists are now forecasting the world's reserve currency will peak as early as mid-next year before starting to decline. Basically, I want to get both of your takes on this. How will this impact your investing approach if the dollar does decline?
Well, I hope it peaks now. That's what I hope. I think the dollar is massively overvalued relative to other currencies. I mean, you can just tell. I've got very middle class friends who go to Europe and they take a bunch of pictures and they post them on Facebook. And these are people who make $70,000 a year. And they go to Portugal and they spend $20 on dinner and $30 on a rental car and they live like kings. Like we have. So just some statistics. In the US, the average income is $60,000. Throughout most of Europe, the average income is about $35,000. And that's in the cities. So if you go outside of the cities, the average income is about 20 to 25,000, which means your average European has a lower standard of living than people in Mississippi, right? That's how much of a chasm has developed between the US and the rest of the world. Dollar on a purchasing power parity basis is very overvalued. So you mentioned the rate cuts. I think we're going to get our last rate cut this week. I think that's going to be the last one. I mean, barring any, unforeseen events in 2025. But I can't, it's hard to say I can't imagine because obviously you have to have a big imagination, but I can't imagine the dollar getting much stronger than it is already. It's massively overvalued.
I could see the dollar get stronger, contrary to what people think. I do think we're kind of at our last rate cut. I think we're going to have persistent inflation next year that people don't. I think it's stickier than people realize. I could see with the innovations with Bitcoin, with Trump, with the Department of Governmental Efficiency, that the dollar gets even stronger. I could see that too. I think the tales of the dollar's demise. I mean, I've been reading things for years that the dollar's, going to go the way of the British pound. They haven't happened. And I could see it even go stronger with, I think, although people are skeptical of the Department of Governmental Efficiency, if they cut, what are they trying to cut out? 2 trillion? If they cut 1 trillion, it's going to be a massive win. And, I remember hearing these things from Tom Coburn, former senator from Oklahoma, about, there's not really that much waste, fraud, and abuse. Remember hearing these things? That really it's unfunded liabilities. Malden always talks about this, that it's not the debt. It's really Social Security, Medicare, prescription drugs, all these things that are causing the pressure on the budget. I think what Elon is saying is it's the whole structure of government contracts, that when the government has a bid for services, they're not getting competitive bids. So that's not called waste, fraud, and abuse, but it just leads to higher prices and higher debt. So I think we get nobody would think that Donald Trump, after the first term, a couple years ago, would have this Department of Government Efficiency, because they spent a lot of money the first term. Biden spent a lot of money. Trump spent a lot of money. But I could definitely see them surprise people. And that, I think, would have a positive effect on the dollar because people would believe in it more.
Yeah, the question is, I'm not disagreeing with you. I totally agree with you. But the question is, how much is priced in? Like, is that priced in? Is it not priced in? I do have a quick story. I remember in the 2000s when the dollar was very weak, right? Remember how weak the dollar was around 2006. January of 2007, I took a trip to Europe for Lehman Brothers. I was in London and I stayed in this hotel called the Sanderson. Now, this is back when the pound was 2-1 for the dollar. The dollar was 2-1 for the pound. And I looked at room service. I looked at the menu, and there was a continental breakfast, which was a croissant and a coffee for 26 pounds, which was $52 in 2006. So I keep bringing up like purchasing power parity, like, the dollar being strong, the dollar being weak. Like whenever you see like extremes in purchasing power like this, like I think we're usually near a turning point. You can't trade off of it, but I think we're usually near a turning point. So
yeah, you could be right. I just think what's priced in is kind of optimism on a Trump White House. I don't think what's priced in is he actually gets it done.
Yes.
And I think that will shock so many people. I mean, a lot of people think it's not going to be done or it's a joke. I don't think so. I mean, I think Elon's serious about it. We'll see. I mean, you got to hope, right?
So last time you guys spoke, on the Financial Quarterback, you talked a lot about Jared's book, No Worries. I want to kind of flip the script a little and talk about your book, Josh, Retirement Reality Check. So I want to break down a few of these reality checks that you lay out throughout your book, starting with the first one. Quit worrying about your money. Most retirement planning advice is wrong. So pretty straightforward question. What does most retirement planning advice get wrong?
I think the whole idea of wealth equals rate of return times time horizon times risk. And people don't live their lives that way. They want to go to Europe and have the croissant. They want to enjoy their talks with their son at Christmas or Thanksgiving or Hanukkah or whatever it might be. So much of, I kind of liken the Dave Ramsey, you've said this with Susie Orman, that there are these, I think the traditional financial planning industry or cartel, if you would, the Susie Ormans, the Dave Ramsey, I don't think anybody lives like that. And if they do, they have a miserable life. So financial planning should be based on joy. Like you should have a portfolio so that you're not worried about it. I mean, I've met so many people before they become a client, they're do-it-yourselfers. A lot of our people before they're clients, they've all their money at Vanguard or Fidelity. And they're just looking for somebody that they can kind of be a co-pilot with and give up a little bit of the responsibility. They want to worry about it maybe once a quarter instead of every day. And some of that's relational, right? You got to have somebody you can trust. You got to understand their ideas. But I think the biggest thing is this traditional financial planning, which I just, not to pick on Dave Ramsey. There's good stuff he does, don't buy stupid stuff, get out of debt. I just remember going to a church with a guy and I didn't see him for 10 years. I said, "Hey, what happened? Hey, how you doing?" He's like, "Oh, I went through the financial piece. I'm out of debt." I'm like, what happened in the last 10 years? He goes, "I was working 2-3 jobs to get out of debt." Like basically the guy gave up a decade of his life, missed his kids. Your kids are only young once, right? His kids were 18. So he missed their period from 8 to 18 because he was so worried about getting out of debt. And then now the kids are out of the house and they don't want to see him anymore because he followed Dave Ramsey's advice. So I think, and you brought it up with Susie Orman, I think with the coffee and the simple pleasures of life. I always like when you talk about that because it's so true. These people would have you not go to Starbucks, but yet they're flying first class. And the little joys in life are more important than, I think, being out of debt 1 year sooner. You know what I mean? So I think the whole traditional financial planning industry has to be kind of have an overhaul.
You said a lot of stuff that jives with, what I said, no worries in my newsletter and a bunch of other places, that makes total sense to me.
I think it's maybe because we came of age at similar times, maybe a couple of years older than me. I saw my parents, boomer parents, right? My dad was born in 1946. So
my mom was born in 46.
So I think if your parents are early boomers, they didn't do very well financially. They got their 401k and they were all excited because it was their pension. And then they lost 90% of it in the 2000 to 2002 period in index funds, by the way. They were heavy NASDAQ. So I kind of developed a natural distrust for the financial industry early, and it kind of has undergirded my whole financial planning philosophy, which is you never know when the crap's going to hit the fan, right? We're always 1 or 2 Fed talks away from the market going down 20 or 30%. And then I've seen people who had everything in the FANG stocks in 2020, January of 2020, sell everything in March of 2020. It changes how you do financial planning, I think,
One of the things I write about is I can't find the words to describe this, but as a newsletter writer, one of my abilities is that I remember how I felt during times of crisis, right? I remember what it felt like in March of 2009. I remember what it felt like in March of 2020. I remember what it felt like in the dot-com bust. And I think that most people they have like amnesia about what those times feel like. So in a bull market, their window of possibility closes and they can't see any other outcomes as to just the market going higher. I don't know if I made any sense, but
I have a keen awareness and it makes me more conservative, but I think long-term it's good. I have a keen awareness of clients that I talked to in March of 2020 and how hurt I was that they sold. I mean, it wasn't my money, but I felt the agony that they felt when you're talking to a 70-year-old retiree and she goes, "Hey, my husband's going to have a heart attack if we don't sell today. And I don't care." And by the way, the person I'm thinking of was a Wall Street veteran. Like she had a Wall Street career for years as an executive with a big firm that you've heard of. But she's just like, my husband can't sleep. COVID is a completely different phenomenon, just like the great financial crisis was, Just like 2022 to 23 was bad because it was like 18 months in a row of carnage. It just kept getting worse every little dip.
It was also bad because bonds and stocks were correlated, so there was no place to hide. Like if you had 50-50 stocks and bonds, you were down 20% no matter what. So
yeah, that was rough. Although in my book Retirement Reality Check, we talked about that, and I talked about the 60-40. I wrote that in 2019, and I want to do a reprint for more modern times. But I said the 60-40 portfolio is a lie, and talked about how, and I think you've talked about this. You talked about this too at that time. Like bonds were not safe. Like bonds were ridiculously risky in 2019. And yet the average financial advisor was having their clients 40% in long bonds. And thankfully, we were very short duration or in things that didn't go down when the bond market crashed. So that was a good thing. But people thought it was ridiculous when I first talked about that the 60-40 portfolio needed complete revision. And that was another part, Cameron, that I was kind of saying that the traditional financial planning concept. I mean, I remember talking to like people from, no lie, I don't want to like badmouth people, but if you had a portfolio with some big name RIA and you told them you were moderate, they just put the 40% in LQD or in, BND, Vanguard's bond fund equivalent. There was no genius there.
What are your views on bonds? Should they be a part of someone's portfolio? And Jared, maybe you can talk to this as it relates to the awesome portfolio. Why should they be a part of somebody's portfolio, basically?
Go ahead, Josh.
Well, I want to hear you talk about the awesome portfolio, but I mean, I think bonds have a place. And then, if you follow risk parity studies, it was just to me late 2019, early 2019, 2018. I just thought that conventional portfolio needed revision. Today, probably bonds are a better deal because people got kind of spooked out of them.
The thing I get with the awesome portfolio nowadays is people say to me, well, why do I need a bond allocation? Because interest rates are obviously going higher, right? And I'm like, I don't think it's that obvious. I don't think it's that obvious that interest rates are going higher. Like I could picture a bunch of scenarios where the long bond goes to 3%. I think that's super possible. And also when stocks are doing really well, people aren't super interested in bonds. The awesome portfolio is constructed in such a way that each of the 5 components plays a very crucial role. And if you eliminate or even underweight one of them because you have some opinion about the future, like all I can say is that markets do what surprised people the most. And I think it's entirely possible that in 2025, you get 100 to 200 basis point rally in interest rates. Like that's not outside the realm of possibility,
No, exactly. And also, I mean, I remember talking to one of the best bond traders I ever met. Not traders, but Scott Minard of Guggenheim.
He passed away, right?
Yeah, he was a friend of mine, wrote for my book. And he made some of the best trades. Actually, the LA Dodgers are fruit of a lot of those trades that they made. They played, those guys, they bought 10-year treasuries early 2010, right after the great financial crisis, because they saw that rates would be lower for longer than people realized. And they made a lot of money every time there was a little bit of uncertainty in the rate environment. They would sell 10s, they'd buy 1s, they'd sell short term, they'd buy long term, they'd flip. So yeah, no, I totally see the point of having a bond allocation now. I see more of a reason for a bond allocation now than I did before the bond market meltdown. But risk parity, I'm not an expert in risk parity like Ray Dalio or some of these guys. I had a guy, I guess, Frank Vasquez. I don't know if you know him, but he's big on something like the awesome portfolio. And he was saying, what happened in 2022, everybody's worried about what happened in 2022 and 2023 for their bonds now. But if you follow bond cycles, that was like a once in 40-year occurrence and probably won't happen again because those, for another 38 years because of the way bond cycles work. But I'm not an expert in bond cycles, but there's the old 40-year cycle that I've heard from some of my cycles friends on bonds. And it makes sense. I mean, I could see rates go down and then bonds rally. I could certainly see an exposure. But that's the point. You want a portfolio with the awesome portfolio, or what we do at my firm, Wealth Quarterback. You want a portfolio that you're never 100% happy with. You don't want it to be up 20 when the S&P is up 20. And it's hard for people to get that because they want to brag about, oh, I'm in Coinbase or I'm in Bitcoin right now. But nobody wanted to buy Bitcoin when they should have bought Bitcoin, which was during the FTX scandal. If you just did the reverse of what people talk about, that would be more successful. Yeah. Now it would be short Bitcoin, short MicroStrategy. I don't know what you go long. You're more you have better contrarian ideas than I do.
Yeah.
But go long international.
That's my trade right now.
What do you like internationally?
I actually have a position in something called ISVL, which is an ETF you probably never heard of. It's a BlackRock ETF. It's the International Small Cap Value Fund, and it trades by appointment. It trades like 3,000 shares a day. And I've been hanging out in it for like the last 2 years, and I like it because it is the most hated factor in the world. It's international, it's small cap, and it's value, right? And one of these days, it's gonna be up like 100% in a year. So I just, I have it as part of my SEP IRA, and I just hang out in it, and it pays some dividends, and I just wait.
We have a monthly meeting with BlackRock's chief investment strategists and their people. I'll ask them about it.
Yeah.
They're good. What's cool about being an RA? We get calls from, a lot of people don't take advantage of it because they're just closet indexers. We get calls from BlackRock, Fidelity, Vanguard, where like we can get their research people to come on. They give you a lot of good ideas.
Yeah.
Stuff like this, that it's kind of like, we got this little fund. And I've had great ideas from some of those meetings. What about, do you like China?
I have never owned or traded China in my entire career. I have gone 25 years without ever touching China, and I think I'm better off for it. The thing with China is, the Shanghai Composite hit 5,000 in the Beijing Olympics, 2008. And now it's at 2,000 something. China is not a free country, to say the least. The gains from Chinese companies don't go to shareholders, they go to the government. It's a crappy place to be a long-term investor. If you're a trader, I think there's opportunities. Back, I want to say it was 22 or 23, when Hu Jintao was escorted out of the CCP and the Chinese stock market was crashing. That was a really good time to buy. There's been some good times to buy from a trading standpoint. But when I look at emerging markets, I buy ETFs that exclude China. So one of the ones we have in our strategic portfolio is called FRDM, which is a freedom weighted emerging markets ETF. There's no China, there's no Russia, there's none of the bad guys, and it has massively outperformed EEM and VWO and all the big emerging markets that have a 30% weight in China. So that's been the way to play it.
I've traded KWeb over the years, when it goes down to 18, when it goes back up to 30. I did think David Tepper didn't get enough flack this summer. I feel like when he went on the news and started pumping China, he was dumping shares that he had bought a year or two prior when they were like $18 a share. I don't know, because I've followed that KWeb ETF. KWEB's the Crane. It's basically the Chinese stocks that are more of the internet infrastructure, like your
like
Alibabas,
and stuff like that, yeah.
But I've found that that's a good one to trade just because I've followed it and I can chart it well. But it's stayed at like 31 for a long time. You're right. It really isn't a good long-term investment. It's more of a short-term trade. Buy it when it drops, sell it when it pops. But I like the idea of freedom.
Yeah, it's
Freedom
a great ETF. And I know the woman who runs the index, and she's terrific. Highly recommend FRDM.
Before we wrap it up here, any thoughts on some of the economic data coming out this week? We've already talked about the Fed a little bit. I think we're kind of all on the same page. We're getting a 25 cut, and then that's it. We agree there?
Yeah. I actually think even though the outcome is a foregone conclusion, I think it will be an interesting Fed meeting because the directive is going to have some clues about what they're going to do going forward.
Right.
If there's any hint of another rate cut next year, the market's going to go bananas. So I don't think there will be. I think they're going to close the door on any future rate cuts. So
I think inflation is going to be stickier than people realize. There's an interesting ratio. I don't know if you've followed this. The guy, David Ranson, who studied under Milton Friedman like 40, 50 years ago, he told me about this thing where you take the spot price of gold and you do it over a ratio of treasury strips. Have you heard about this?
No.
And if you plot it on a graph, it will tell you future inflationary numbers. And when all these people said rates weren't going to go up years, after COVID, this indicator was spot on. And this indicator is showing that inflation is going to be stickier. So until it's wrong, I'll believe in it. Because it's been right the last 6-7 years. I've had this guy, because that's what's so great about doing the radio show. So if you listeners don't know, I was on WR, which is one of the biggest. We had more listeners in New York than Dave Ramsey. I wish I got into podcasting when I got into radio, because now it's.
I know all about that. Trust me.
But when I was doing it, I remember doing podcasts when nobody else did them. And we had like 500 listeners, so I got pissed off and I quit the podcast. And I should have just stuck with it. But being on New York radio, you hear all these interesting people with interesting, theories. And that gold ratio as kind of a signal for future inflation prospects and, consequently interest rates. I agree with you. I don't think we're having any more rate cuts.
Yeah.
Well, Josh, where can people find you? Your website, your socials? You want to plug those in?
Sure. Download The Financial Quarterback on Spotify or Apple. My website's Jalinski.com, JALINSKI.com, and books Retirement Reality Check on Amazon.
Well, thank you, Josh, for joining us. It was a fascinating conversation here. We'll be back here soon, and take care, everyone.
Thanks, Cameron. Thanks, Jared.
See ya.